So, chat. All done? Still, you want some time? So, chat. No. I think there is a time adjustment about chapter 3 assessments and assignments. Don't worry about it. I'll update it. For chapter 3, smart learning, chapter 3, assessment, you got the time till next week. I'll do it right now. Let me try. This week you also have chapter 4 for smart learning, but that is not graded. Okay, you have to take care of chapter 3 smart learning and chapter 3 assessment. Only two. Rest of the things just follow whatever it is asked. Okay, shall we go ahead? Done? All done? Okay. So let's go to the next topic. So till now we have seen how securities are issued to the public or private or target investors, whoever it is. Securities are issued, we discussed in equity point of view. Now, how they are traded. The first phase got over. Now, the second phase. They have the liquidity. The shares which are issued in private placement, are they traded? Any guess? Shares issued in private placements to one or few institutional investors or whatever, are they traded publicly? No. Only shares which are publicly issued, they are traded. Not only that, rights issue, they get converted into shares which can be publicly traded. Okay. So in that context, let us discuss about this, how securities are traded. Remember, we are going to talk about secondary markets now. Primary markets got over. Now we are switching to secondary markets or stock exchanges. So here the idea is to understand different types of orders if you want to buy stocks in stock markets. Okay. And the second one is what are the trading practices, how it happens in different exchanges. And the third one is and understand, compare the mechanics of investment implications when you use some investment strategies like buying on margin, selling short on margin. These are the three objectives of this topic. At the end of this topic, you should be comfortable with that. And if you are not convinced, you can ask me. Okay. Now, so what I did is I categorized the whole topic discussion into these two parts. This we can call it as more of market microstructure. What are the orders? How are the trades? How it happens? Okay, internally in an exchange, in the order book, the trade book, how they're recorded, and so on. So we'll discuss all these things. And later on, I think this is a bit repetition of what we discussed in the previous session about the markets, secondary markets. Okay. So I think some of you told me you got some shares of Tesla, if I'm not wrong. How did you guys buy the stocks? May I know from you? Sorry? Robinhood, okay. Please listen, all of you carefully. Yeah.
I use E-Trade.
Easy Trade?
E-Trade, yeah.
E-Trade. E-Trade, Robinhood,
Charles Schwab.
Charles Schwab. Okay. Anyone else? How about other investors? How did you guys buy? Sorry? Fidelity, okay. Good. Anyone else? Sorry? Okay. Yeah, someone will say something. JP Morgan. My intention of asking you this question is, if you want to buy the shares, you can't directly buy. You need to have a broker. You need to go to a broker. Without a broker, if you remember in our money market instruments, is the broker mandatory or not? I had put a slide for that, right? For example, treasury bills, you need not. Directly you can buy. In the case of stocks, you can't directly sell and buy, because what's the reason why we need a broker here? What's the intuition? Okay, agreed. Any other reason? Why? You have your own Tesla stocks or stocks of Google or whatever. Why you wanna approach a broker? Because remember, he charges you with the brokerage. Let it be Robinhood or Fidelity or whomsoever, it's not free of cost. Yeah, you're saying something. Oh, okay. Here it is simple process. You got the shares, you want to sell. That's it. It's a simple trade. Maybe you're talking about investment management, portfolio, and so on. We're not going to that extent, but a simple trading platform. Why I can't buy directly from someone? Why I can't sell someone directly? Why a broker? Okay. Even if you try to do it for yourself right now, sitting in the class, can you do it? If you want to sell your shares here or in Boca or in Florida or in US by yourself, it's very difficult to find the buyer if you want to sell the shares. Where will you search them? If you want to buy, you don't know who is holding. Forget about stock. You got your mobile phone. It's very difficult to sell your mobile phone, smartphone. You go to Facebook Marketplace or something like that. You can't sell them directly. It's a market. You need a market. Why? The reason here is this. Why people go for stock exchanges and stock markets? These are the reasons. Stock markets provides participants. It brings all the participants together to one place. Buyers, sellers, investors, intermediaries, any kind of trade related service providers, they're there. Price discovery happens, again coming back to our classroom example. If you could find a buyer to buy your stock, what's the price? Okay, you want a too high price, the buyer wants a too low price. We are greedy, right? So we want to make money. So price discovery happens in markets. Low cost of transaction compared to one-on-one, then it saves hell lot of a time. I think I don't know whether I told you or not. I'm an active investor. I used to manage portfolios. I was also a stockbroker. In the earlier days when online trading was not there, you know how difficult it was. Oh my God, it was so tough. It was online trading. You can trade on your mobiles. It's quite easy now. Okay, so this is bringing costs down. Brokerage used to be very high in those days, but now there's nothing. A lot of competition. Not only that, when you want to buy a stock, like in the last week we discussed how did you buy the stocks and so on. You are looking at advisors, kind of sources. There are free sources if you want to buy. So that's what you call as information cost. If you want to look at, say, agri product industry in US, if it is expected that the demand is going to increase for this kind of products in US because of the trade tariffs or so on, if there is a excessive demand for these companies, you need to find them. How do you do that, right? So that is the cost of information acquisition. So that also has come down drastically. Now coming to secondary markets, again, I categorize them as exchanges and OTCs. Again, we are seeing OTCs here. Where did we see the OTCs? We have OTCs in secondary markets. Where did we discuss? In primary markets also we discussed. Private placements, direct public offers, direct listing, foreign listing, all delisted companies going for issues, they all happen in OTCs. Not only that, secondary markets also, you have OTCs. The reason here is, I was just asking you, are shares issued on private placements, are they publicly traded? No. But they can't hold forever. They also want some liquidity. They wanted to sell to big people like them. OTC is the answer. They sell their stocks in OTCs. So there also we have liquidity. I think we have more discussion on this. We have a informal network of brokers or dealers negotiating the trade, and just an auction. We call it as ECNs, which is Nasdaq was popular. So in exchanges also, we have a dealer market and the auction markets. Are you aware? Any idea how the trades happen in the New York Stock Exchange? I think I was planning for a simulation, but I don't know what are the possibilities of that. But some way or the other, we need to have hands-on experience on seeing the screen and putting the orders and doing the trades, at least mock trading kind of thing. We have to do that. Maybe in the coming sessions, I will announce that we'll be doing for that. So in the New York Stock Exchange, like I was narrating my own experience earlier. The technology was not there. It was physical trading. Online trading was not there. So it was like an open outcry. I used to see them participating something like this. Come on, they used to yell like anything, right? Now also we have floor trading in New York Stock Exchange today. So what I'm trying to say is we have dealers market in New York Stock Exchange, which happens through specialists or DMMs or dealers. But now, because of the technology, we have both. We have floor trading to some extent and more dominated by online trading because of Nasdaq. Nasdaq is online trading, which has auctions where electronic orders come out. So this is what I was referring to. Electronic communication networks were trending in 80s, and it changed the way stocks or securities are traded. So instead of going, instead of physically accessing an investor's broker's place, which consumes a lot of time, ECN saves a lot of time with the computer interface. Now we have the smartphone interface. And here I was mentioning about exchanges in New York, talking about New York Stock Exchange. We have a specialist. We call them as designated market makers. Who are they? They take care of the liquidity and volatility of a stock. In New York Stock Exchange, every stock which is listed is designated to a market maker. What does that mean? We'll discuss bid and ask spreads a little later. But before that, they ensure that price is not too volatile. They're not merely brokers. They put their own money to ensure upside and downside risk. Market is not free falling. Market is not abruptly going up. That is the role of DMMs. They were known as specialists. Now they are called as DMMs. We also have dealers in Nasdaq also, but their role is different. But the prime role of DMM is to provide liquidity and contain volatility. Importantly, in very drastic situations like economic announcements or big thing happening in the country or in the world, whatever. So I think that is their role. But in New York Stock Exchange, the orders go through DMMs and through electronic orders also, ECNs also. So when you want to buy, okay, assume today still the market is open. The market closes by 4 o'clock, opens at 9 o'clock. You put the order before 4 o'clock today, you bought the stocks. So when will you get the shares into your account? Sorry? Next day. That's what we call it as, technically we use the word T+1. It used to be T+2. Thanks to technology, it has come to T+1. If you're selling the shares, tomorrow you'll get your money. If you're buying the shares, tomorrow you'll get the shares. But if you're buying the shares, today itself you have to give the money so that you can get the shares tomorrow. If you're selling the shares, today itself you have to give your shares so that you get your money tomorrow. Got it? So this is good because of technology. Yeah.
So when I buy shares, let's say today, I technically don't have it ownership till tomorrow.
I will discuss that. Oh, okay. Your question is no. Till T+1, you don't own them.
But it's in my account that I have them.
They'll come to your account tomorrow, not today. He has a good question. He bought the shares today, but can he claim for a dividend if it is paid today? No. Tomorrow. It will be on your name on T+1. Good question. Okay. So there are more deviation strategies on that. I will discuss those strategies. There is something interesting. Speculation. I think more than going for what do you call long-term investments, people look for quick money, instant money. We all want money quickly, right? We'll be happy, so happy if we get more money quickly. So the platform is speculation or intraday trading. So what do you do there? You buy the shares in the morning, okay, and sell the shares before the market closes. Got it? Okay. If I want speculators want the market to be very volatile. Very volatile means prices will change drastically so that I can encash out of it. Okay. So say for example, I took the position in Tesla for 340. Took the position means bought Tesla shares for 340. Follow my question carefully. I bought the shares in the morning by 10 o'clock for $340. For simplicity, 340. What will be my expectations from there onwards about Tesla stock price? As simple as that. I want the Tesla stock to reach 350, 400, 500, maybe $1,000. I want to be rich. That's my expectation. That's a mindset when you speculate. Please remember. Okay? So the idea, this you call it as long position. I took the long position means I bought the shares and I will sell the shares before 4 o'clock at a profit. That's the idea. Okay. So 340 Tesla share has become 340.90 cents, $340.90. By 3 o'clock, I closed my position. I sold the shares. Got this example? Bought Tesla for 340 in the morning by 10 o'clock, closed the position, was selling them for $340.90. Say I got 1,000 shares. What's my profit? 1,000 times 90 cents. Okay, $900 is my profit. What happens if the price goes down? I got it for 340 and it slipped to 339 by the evening. What do? I told you I'm a speculator. What I have to do? I have to sell the shares at any cost because 1,000 times 340. $340,000 I don't have. I don't have that much amount. So what do? Whether it is profit or loss, I need to square my position, close my position. Let it be loss because I don't have that much money. Is it clear? That's how speculators do it. Similarly, this is long position. Bought with an anticipation price to go up, square off by selling them. Position closed with profits or losses. Now it is the other way. I'm speculating that Tesla will go down. What will be my position? What will I do in the morning? Sell the shares. Tesla is trading at 10 o'clock by $340, same price. I sold 1,000 shares. Okay. Then what is my anticipation? What do I expect the price of Tesla to be? Fall down so that I will make money. So by the end of the day, 3 o'clock, I bought the shares because I need to close the position. I bought the shares for 339.10 cents. 90 cents is my profit. Times 1,000. $900 is my profit. If that happens. If the price goes up to 340.90 cents, I lost $90. But I can't say I will hold, see for the next day. I sold the stock, but I don't have the shares. I'm speculating. I don't have 1,000 shares with me, but I sold it. So I have to square up whether it is profit or loss. So that is a quick navigation how speculators will operate. So short positions, long positions, this is what you mean by long position, short position when it happens to trade speculations. Okay. Now you'll have a better understanding if you got this. I think it was, let us take a break for 10 minutes. We'll meet again. Let's continue. So I was mentioning when you want to buy or sell securities, you go to a broker, and reasons we have seen because there was no other option. And the broker is not at free of cost. There is a brokerage for that. He charges on you as a some percentage. So basically we have the commission the broker charges on you to your account. And more than that, we have something to discuss today that we call it as spreads. The spread we are referring to is the bid and ask spread or the bid ask spread. Let us see what exactly they are. So what I'm trying to show you here is we have only brokerage, or we may have an additional cost of spread, which is a kind of transaction cost, or a combination of these two. We may have this also. So when you look at bid and ask, so if you see the electronic, I will show you. If you see the electronic trading screen, you will have to your left, you will have the list of bids, and to your right on the screen, you have the list of ask. So what is bid? These are the prices available on the screen to buy the share. As you're talking about Tesla, say a bid is there for 340, another bid is there for 345 cents, 10 cents. So there are like that, there are many bids. Ask. I said the best bid is $340. Someone wants to buy. Can you tell me what will be the ask? It will be more than bid, or less than bid, or same? What's the logic? Yeah. We have the bid. Okay, let me come back to a simple example. I want to sell my phone. I said it is 1 year old and I got it for $900. I'm saying my price is $700. I'm selling. So my price is 700. What do you call that as? Bid or ask? Perfect. Mine is ask. So one of you came forward and you want to give your own price, which we call it as bid. My question to you is, your price will be forward and you want to give your own price, which we call it as bid. My question to you is, your price will be less than my price, more than mine, or same? I'm seller. You are the buyer. I'm saying 700. You will offer 800 for me? I'm selling. For my selling price is $700. I said sell. You want to buy my phone. When I offered you for 700, what is your offer? What will you say? Less than that or more than that? Obviously less than that. I'm saying $700. Obviously you say 600, 500. Can you give me for 400? You try to negotiate or bargain. Why I gave you this simple example is the same thing happens in the stock trade. Okay, coming back to the question, when you see open a trading screen, to your left, you have the list of prices which are for buying. My question to you is, one of the best bid is $340. To your right, there will be a list of prices which are for selling Tesla stock. My question to you is, this will be more than 340 or less than 340? More than 340, because this is seller. Seller price is always greater than buyer. Whether you go to a shopping mall or any place, when you're trying to buy, buyer price will be lower than seller price. Right? The same logic applies here also. So I already used the word best bid. Best bid means the highest whoever quotes, it will be the best bid. And the ask is the lowest whoever quotes will be the best ask. I'll show you a screen because in the live I couldn't get the US here. Okay, I'll talk when I go to that. Okay. So bid is the buy price, sell is the ask price, or ask is the sell price. So best bid is the highest bid prices. Now coming back to my example, I want to sell my phone. I said $700. She said $600. you said $650 and he said 675. Who is best? Obviously. So the highest bid is the best bid. Got it? So simply it happens with the ask also. Ask is the sell price. I'm saying 700. Then another guy in the same class says, hey, why are you paying 700? Same phone, same version, same features, 1 year old. I can give you for 650. You will look for 650, right? So the lowest ask price is the best ask. Then bid ask spread. The difference between the sell and ask. I'm saying 700 and she's asking for 500. I think too wide. I think trade, there are least chances that trade will happen. I'm saying 700, he's saying 675. There is always a possibility that trade will happen. So the spread is less here. The spread is wider here. That is the importance of spreads in trades, securities trades. So smaller the spreads, high is the liquidity. Wider the spreads, low is the liquidity. So if you want to calculate the spreads to know how liquid are the markets, simply ask minus bid, that will do. But sometimes as it is too narrow or too wide, you may convert that into percentage. You have to use this formula. Depending on the context or the question asked, you have to use. Then market depth. I think traders who are actively investing, they'll know about all these things. But still, it is important for all the students here to know about it. Because if you make an investment decision, you should know about the liquidity, where we'll be seeing with bid-ask spread and depth. So depth is what are the top 5 buyers and what are the top 5 sellers and what are the total quantity for buying and what is the total quantity for selling. If these two are more, market is very strong. Hardly there are any buying quantity, market is very bad, low liquidity. That's what you call it as market liquidity. Then there's something called effective spread. Effective spread is a new thing out of research. It came in, I think, Kyle. Kyle is the one who introduced lambda. Kyle's lambda, it is known as. He has introduced effective spread and other impact costs reflecting the liquidity of the stocks. Okay. Now, this is the formula. So how do you get effective spread? So I'm not happy just looking at the difference between bid and ask. So what I want to do is add bid and ask divided by 2. That is the average or the midpoint. Technically, we call it as midpoint of bid and ask. Deduct this from the execution price. Whatever is the last traded price or just executed price, compare that with the midpoint of the bid ask, multiply it by 2. This is the formula. So what we call it as effective spread. So how do we use it and what it reflects? Let us see. I couldn't get from NASDAQ or New York Stock Exchange because they don't give you that information. Only if you have the access to a stockbroking account and you open your trading screen, you can see it. But in Bombay Stock Exchange and NSE, they make it available for all the stocks and indices. So I thought, let me present a picture of this so that you'll understand the bid, the ask, the spread, the effective spread, and the market depth. As I was mentioning you, this to your left is the list of buy prices or the bids. To your right, sell prices. You can see this is the best buy price is the highest, 14.40. This is the best bid. And after that, this is less than this. That is the reason it is second. This is less than this. That's the reason this is below this. However, this is the highest price or quote from a buyer. This is the lowest quote from a seller. 1470. This is higher. See, this is 70 cents. This is 90 cents. So this is lowest. This has become best ask. Okay. Now, not just that, you have to look at the price is okay, but look at this. He or she is selling only 20. He wants to buy only 20 shares. But here he is selling 8,000 shares. That is huge. That is huge. So even if he buys all these stocks, still, if he sells all his stocks, still he's short of selling his stocks. Okay, that is about top 5. Then total market, this is at a given point of time, at a given time. It keeps on changing. Total buy quantity is 78,278. And total ask quantity is 240. What do you get this? What do you get from this, Radha? There is a selling pressure, I see personally. There are more people to sell than more total bids. Make sense? So what I'm trying to say is, if you look at the market depth, you will have an assessment of the liquidity, how the market is. Should I wait? If I'm a buyer, I will wait. If I'm a seller, I'll try to quickly sell, looking at the picture. Okay? Now, if I ask you to calculate bid-ask spread, this is the answer. The difference between ask and bid. Can you quickly tell me what is the bid-ask spread in percentage? Calculate and tell me. What's the formula? Ask minus bid divided by you want me to show the formula? This is the formula. Ask minus bid divided by bid. Okay. So what I'm asking you is, please calculate the bid-ask spread for these two. Because this is the best ask, then this is the best bid. Answer? How much? 0.23? How about others? Use your Excel, use calculator. I think you can use a mobile. It's a very simple calculation. Ask minus bid divided by bid multiplied by 100. Any other answer?
Are you talking about like the first quantity, like the 20 or like the?
Yeah. This is the ask. This is the bid. Maybe that's the confusion. I'm just repeating again. When you say ask and bid, which ask you have to take? The top one. This is known as best bid. This is known as best ask. You should always calculate best bid and best ask when you're calculating spreads. Any other answer?
I mean, kind of like how 0.02, I believe.
That's okay. Whatever the answer you can share with us. 0.023? 28?
0.0.
Okay, let me check with my answer. So I'm with you. We are right, we did well. 0.028%. It is low a percent because the hardly 30 cents is the difference. Okay, it's very low. So lower the spreads, higher the liquidity. Liquidity is good. They are inversely proportional. Lower the liquidity, higher the spread. Higher the liquidity, lower the spread. So you want low spreads or high spreads? What do you say? Low spreads. If you are looking for liquidity, you want low spreads. Low spreads, high liquidity. Fine. So the spread is very narrow. Liquidity is good with high volumes. The volume is so great. 240,000, 78,000. So good. Okay. What next? Market depth. I think depth is also good, not that bad, though this one single quantity is 8,000, but still we have here 2,500 plus, not that bad. Okay. So as I was mentioning, because of that, ask quantities and prices, there could be a selling pressure. Now comes effective spread. So effective spread is, I will just narrate this. This is bid, this is ask, sum of these two divided by 2, that gives the midpoint of the bid ask spread. We want to know midpoint of this, and this deducted from this. From what? This is what? This is execution price. Okay, some interesting question to you. Something interesting to you. He is saying 1440, and she is saying 1470. At what price trade will happen? Okay, putting the other way, it should be either at 70 or 40. You got the logic? You got the point? The trade should happen if there are only two buyers. I'm saying $700 and he's asking for 675. We are only two. The trade has to happen. Either he takes my price for 700 or I give to his price 675. Same is the case here. This is what we are testing in effective yields. So as a buyer, which one you want to happen at 40 or 70? That's it. If it is happening at 40, there is no additional cost to you. You saved. Okay. Effective spread cost is not there for you. There is no additional transaction cost, zero. But if it happens at 70, you paid 30 cents more. In addition to your brokerage, you're paying 30 cents more. That is the idea of effective yield using bid-ask spreads. Got it? Okay. Yeah. I gave the example here. But the logic behind of giving you that example is it should happen at 70 or 40. I gave you the example of 70. So the answer is how much? Effective spread is 30. That's the answer we got. If it is 40, the effective spread is 0. You can try if you want. Got my point? So because why you're getting this? Because you got the trade for 70. What is your order? 40. Your order is for 40, right? You'll be happy if you get whatever you have bid it for. But he's not coming down and you are obligated to pay this price. That extra you pay because of this spread. You have to bear additional cost. Remember, because the stock is so liquid, you're just paying 30 cents. If this is not liquid, you have to pay more. I'll give the other example. Look at this. What does it look like compared to the previous stock? Better than that, same, or the worst? In terms of what? Any views? This is a different one. I'm sure it is different from the previous one. What do you say? Yeah. This? No, so in terms of liquidity, this is good or previous one is good? Previous one is always better. See the spread, 3.448%. Look at the screen once, all of you, please. To have a quick comparison. In the previous example, we just had 0.028%. But here, we have 3.448%, which is huge. It is an illiquid stock. So, for example, my best bid is, this is my quote, 116, I wanted to buy one share. See how liquid it is. One shares are offered. Okay, here 230, okay, some hundreds. So 116 here, 120 here. $4 is the spread. That is high. So in this case, if last trade happens at 120, I'm gone. That's a huge impact. If it happens at 160, it is okay for me. Okay? Clear? Any question on this? Bid ask spreads, market depth, effective spreads. Clear? What is that we are trying to do here? We are trying to see the impact of the bid ask spreads on your cost.
What would be kind of the, like, point at which?
There is no benchmark. It all depends on your stock belongs to which industry. Is it an index stock or non-index stock? For sure, this is not an index stock. No index stock will be like this. Okay. So that's a good question. You got his question? So is there a measure? Yeah, for you are looking for Tesla, look for the liquidity, and you're not impressed with that, look for the other stock which has a product like Tesla, or the size or whatever. Whatever the liquidity is good, you go for it. Okay. So some interesting pictures on the market depth showing large cap stocks are more liquid than median or small cap stocks. Historically, 2003 to 2013 for 10 years. Market cap is, the range is 20,000 to 160,000 for median stocks. But for large stocks, it is 200,000 to 1 million, 1.6 million. So market depth is good for large stocks. So the first example we have seen is a large stock. Second example, we have seen a small stock. It's a penny stock. One more interesting trend to share in the class. How there is something called in the order systems, we have 8s or 16s or decimal regime. So based on the differences in this, the effective spreads have come down. So from here till here. So it's all about the spreads. So again, repeating, spreads make your rates costly or cheaper. So it is a wise strategy to pick up the best spreads when you trade, buy or sell or invest. Now, coming back to order executions, if you want to buy or sell, we have seen some kind of orders here. We didn't see the orders actually. We have seen the auctions. We have seen the bid and ask. But if you want to buy Tesla again, coming back to Tesla stock, how would you put your order? To start with, market order. I think markets are closed now. If not, we can see the latest markets and decide what is that. So market order is, in the previous example, if you see, say this is the best ask, this is the best bid. You want to buy immediately. Okay. Then what would you do? You will change this to 70 and take from him. That you call it as market order. You're in a rush. You want to buy immediately. Similarly, if you want to sell, you are the seller sitting here or somewhere you are seeing this market depth. You want to buy immediately. Okay. Then you look for the best ask. If you want to sell, you look at the bids and take for the best bid. Okay, that you called as market order. What the broker will, if you say, bro, I'm in a desperate urgency for this stock. I want to own this. What are the prices? You just take it. So whatever is the best ask, the broker will put the order for that. He need not type it also. There is something called market order. Whatever is there as the best ask, you will get that stock for the price. Then, like we are seeing a lot of market depth. Sometimes looking at this quantity, we are giving our own views and comments that there could be some selling pressure. So I don't want the market to see that. What I do is I put the order, but I hide my price, I hide my quantity. That you call it as hidden orders. It is a normal order, but it's a hidden order. This is what I'm talking about. I want to hide my bid or ask. Then price contingent orders. There's something interesting. Limit orders. Limit orders. Tesla is available at 340. I'm using the same example so that we'll be on the same platform. I want to buy the stock for 330. Okay. 330. Just listen to me carefully, pay your attention. Tesla is trading at $340 right now. Exactly. But I want to buy at 330. What happens if I put my order for $330?
Just stay there. It's open.
Mine will become among the bids, but mine is not the best bid. Best bid is the highest bid. 340, around 340, some bid is there, but I want it for 330. I place my order for 330. Okay. Then what does that mean? 330 means if the Tesla comes down to 330 or below that, then my order gets executed. That you called as a limit order. Okay. Why we are calling as a limit order? If you just put 330 as a plain order, the price has to touch for 330 exactly. If it has traded for 335 cents and came down to 329.90 cents, your order will not be executed. Okay. So what I give the condition is the trade, I'm ready for 330 or less. Okay. So any price at 330, at 330 or any price below 330, my trade gets executed. That you called as limit order. Then stop loss orders. I think we are talking about long position and short position. I bought the shares of Tesla for 340 with a speculation that it will go above 340. But I'm seeing that it has come down to 339. So I'm around 3 o'clock, 3 p.m. in the afternoon. Market will close in 1 hour. So I will ask my broker to put a stop loss order at 328. I will wait. 329, I don't want to sell. I will sell if it comes to 328 and below, so that my losses will be stopped. That we call it as stop loss orders. I'm giving the examples of buy. It happens with the sellers. So that's how the orders goes. And this is something important. Your assignments or evaluations or exams, just follow carefully. This is what we discussed about normal trading, buying stocks, selling stocks. Any question till now? All clear? In that case, let us see some trading strategies. I think I told you about speculation. That is also a kind of strategy. I want to make money without investing in the same day. I'm ready to take losses. So beyond that, if it is not within the day, beyond a day, okay, I'm not in a hurry. I want to do a kind of speculation or whatever. I want to do beyond that also, I can do it. And before we go into that, if you want to buy stocks, it's not necessary that you have to have full money to the quantity of stock you have bought. There is always a provision that you can borrow from broker. If you remember, broker call market we have seen in money markets in the last week. So these are the loans given by the brokers to the investors. So that's what we'll be discussing now. So it's like again the same. You buy and wait for a target price to be sold, or you sold now and wait for a target price to fall down. It may happen both the ways. And the difference here is this happens with margin. Margin means, going back to the same Tesla example, 1,000 times $340, 340,000 you don't have. But the rule says, the federal rule says, you have to put 50% as initial margin requirement. 50%. So 50% of 340, how much? 170? 170,000 you have. Rest of the 170,000 you don't have. What do? You ask your broker. He will lend you. Okay? So how he will be lending and what is the risk involved, we'll see all those things now. Okay. There are more other strategies, maybe youngsters would be more interested to take more risk. So this is beyond that, but I'm just sharing whatever we had historically. Algo trading, high frequency trading, block trading, and DMS. Now let us see what happens if I invest in a stock and hold it for a time period. Okay. With margin, I'm saying. So long buying on margin, or you can also call it as margin buying long. So what do? You have your own money. Remember, borrowing is not mandatory. If you have your own 340,000, you're free to go. But there is a provision that brokers will lend you. 50% initial margin requirement, 50% you can borrow. Or the other combination, you want to put 75% of your money, borrow 25%. It's up to you. It's all up to you. So whatever there is the combination, just borrow and buy. And profit, yeah, like I told you about long position, you profit if the price goes up. So I think I'm wrong here. This is downside risk. This is not upside risk. If you are a buyer of the stock, you have the downside risk. If the price goes down, you're at risk, right? You got it? If you're a buyer, the long position holding the stocks, you want the price to go up. But if the price is going down, you're at risk. So that you called as downside risk. I'll change this later, but you correct it for yourself but right now. Then if the price is going up, you're happy. Your broker who has given you money, he's also happy. But what happens if the prices come down? That is when the broker will give a margin call. Bro, you have breached a certain limit. You need to deposit additional amount. Okay, that's what we'll see. But initially, if you do the trade like this, I just made up a return trade-off. How will be your return? You bought the stock for $70, 1,000 shares. This is a total investment, but this is not your investment. 50% yours, 50% brokers. Okay, and I assume that broker charges you 9% per annum on 35,000 you have borrowed. So at the end of the 1 year, you're supposed to pay him 38,150. Okay. Then how it goes after 1 year? If it is 70,000, the stock price remained the same. You're at profit or loss? Actually, no profit, no loss. But you are lost in this case because you owe $900 to the broker. Okay. So that's how 9% loss is showing here. You have to pay broker 9%. If it is your own 100% money, 0%. You will find 0% here. That's the difference. So the price goes up, you're good, all smiles. Right? Reaches 75, 5.5%. It goes to 80, 20% closely. But if the price comes down to 65 and 50, this happens. Why I'm showing this to you is it's very dangerous. It's not that easy. It is risky. Downside risk is there. One way you're facing the downside risk, and moreover, you have to pay to the broker also $900. Okay, so that's how it goes. Now, if you look at how the margin is called or margin is asked by the broker, that's how it goes. As I told you, 50% is the minimum. If you buy stocks, 50% you have to pay. Or whatever, if, I don't know, 50% or 100%, this is the money I have, you say. You have $10,000 with you. Then you can buy stocks worth $20,000. You can calculate that way. Then maintenance margin is, I think most of my friends, they say that, hey Shiva, I think I need to pay 50% initial margin and 25% maintenance margin. So total I need to pay 75%. No, that is not the way we calculate the maintenance margin. I'll show you how it has to be done. So 50% is the margin, 25%, the broker will call you if your position net worth falls below the 25%. How it is calculated, I will show you. So first, let us see what is your net worth if you are buying on margin call. So total market value, what is the example in our previous slide? 1,000 shares, $70. Okay. So market value is 1,000 times 70, 70,000. How much was borrowed? In our previous example, did I tell you? 35,000. I paid 35,000 because initial margin requirement is 50%. Then This is what the broker looks at. My market value is very important. Say, for example, margin requirement is 25%. And this is what he's referring to, 25%. If this percentage comes below 25%, he will call you to put more money because downside risk. The other way to know your market value position, borrowed money 35,000 divided by 1 minus initial margin is 0.5. So when the broker will call you, when this is less than desired margin call or market value falls below that. I think I carry the same example. The percentage net worth is 50% for me. So 50% or 50,000, that value it is keeping, it is 50,000. So broker will call you if it falls below that or 50,000. Okay. So my percentage, my net worth percentage is 50%, and market value should be 58,533. That is my intention of calculating that and showing that to you. 58,333. If anything below that, you will be in trouble. So if stock price, what I did is how the market value changes. If I got it for $70, now it is for $60. So now my net worth would be changing. Okay. So my net worth in the previous slide I was showing, it is supposed to be 53,000 plus. But now, as it has come down to $60 per share, it has become 41,000. Then the broker calls me for a call, margin call. I think your PDF is better. It has a full thing. You can see there also. Is skipping here. So the difference is 53,000 minus 41,000. So additional 60,000, 16,000 you have to keep with the broker. So how frequently these adjustments will happen? Every day. At the end of every trading day, the broker prepares a balance sheet. This is your net worth. This is your liability. If it is positive, it is on your name. If it is negative, you have to pay. As simple as that. So I'm showing you 16,000 here. So your surplus, your net worth is negative. Negative means the broker will call you. Okay. So that's how the margin trading is done with a borrowing. Then the same is the case. The example I gave you. So this thing, I think there are more examples in your textbook, and you do your smart learning, that will be more beneficial to you. I strongly suggest you to go through a end of the chapter exercises and prepare a small balance sheet kind of thing, which I prepared just for you. The example which I gave you now is for a long position. The same thing happens for a short position. It's a repetition. Okay. So simply here, same stock 70,000, IMR 35,000, my investment is 35,000, borrowed is 35,000, and with interest, this is the repayment I have. So this has downside risk or upside risk? My position is short. In the long position, we have seen we have downside risk. Now we have a short position. We have downside risk or upside risk? I'm short position. I'm a speculator or investor who sold the stocks now. So my anticipation is what? Prices to go down or go up? I sold Tesla for 340. My expectation is what? Go down or go up? Go down. Then only I will make money. Okay. If it goes up, I'm at loss. So upward risk. Short position, upward risk. Long position, downward risk. Okay. So the returns also just to quickly gave you here. If there is no price change, there is no gain on the stock, but you owe something to your broker. Okay. If it is not borrowed, yeah, you're absolutely fine. But if the price goes up, see, you are negative. The price comes down to 65 or 60, you're positive, you're good. Okay. So same margins example I gave you here also. Only difference here is there in long position, I borrow from my broker. I borrow dollars, money from the broker. But if my position is short, I borrow what? Stocks. I borrow equity from the broker and sell them in the market. Later, I will buy them and clear my dues. So this is just opposite to that. I just summarized also the same thing which we have discussed. By the way, if you're receiving the dividends, long position, it is yours. If your position is short and you're receiving the dividends, you have to give back to the broker. I think this is a kind of repetition which we have seen in the last session. American markets led by New York Stock Exchange and NASDAQ. These are some of the trends from 2004 to, you can see the falling trade volumes percentage. In 2004, it was 80%. Now it has slided down in 2012. I couldn't get the latest ones, but I think it should be something different. This is because of ECNs, technology trading. So this has been growing since 1969 when it was introduced ECN. In addition to securities exchanges, stock exchanges are self-regulatory bodies, and they also dictate some terms to the stocks listed. I mean, to the companies listed. Importantly, related to insider trading, the disclosures, the stock exchanges monitor very closely. If there is any high volatility in some stock for no reason, there is no public information, but stock is very active. It means insiders are aware of that information and they're actively buying. And sometimes you might have seen upper ceilings will be there. The up ceiling, down ceilings will be there. When the price is going up, it will be frozen for that day. And it will open next day. Markets will take care of that to avoid insider tradings. I think this again a repetition we have seen earlier, the top 10 stock exchanges in the world and so on. Okay. I think this is all about how securities are traded. Is there any question from this quickly? You're good? So it's important to note about what are the types of orders, how the issues are traded, the spreads, margin trading. Margin trading means both buying as well as selling. That's very important. Okay. If you get a job in one of the stockbroking companies or investment banks, you will be assigned to do all these activities. So better you practice all these things. You should be good in all this nomenclature, terminology, whatever. Get used to those screens. That's very important. Okay. So we have the other topic today.